Hello. Yes, good afternoon, everybody. I hope you can hear my voice and also see my screen clearly. So there is one thing which today I want us to look at. I want us to specialize basically on a strategy which involves trading the 5 minutes chart. So the first thing which I'd like to say is that personally, I do trade 1 minute, 5 minutes, and also 15 minutes. So if you want to trade this strategy very well, you may want to trade it on the 1 minute chart. You can also look at it on the 5 minute chart, or you can also look at it on the 15 minute chart. But today, basically, we'll be specializing on the 5 minutes time frame. So with that said, I'll switch to the 5 minute chart, and then we'll look at it now. So the first thing which I want us to mention is that for you to get it right with this strategy, there is some things which you need to understand exactly how they go about. There's some few things which are actually very, very useful. You really need to understand how they're drawn or how that you identify on the chart so that you know exactly whatever we're looking at. So the first thing you have to be able to pick out is you must be able to pick out the high and the low of the previous candle, the previous day's candle. So you must be able to identify. I know it's automatic, it's natural, but it's easy. You may just come here and then pick the previous day's candle. It's here. This is the previous day's candle. You pick its high, and then you pick its low, and then you switch back to the 5 minutes time frame. So if you minimize your chart, now you'll see exactly what happened during the previous day. This is everything which happened yesterday. So we had the price open somewhere here. It went down, came back up, down, came back up, down, came back up, went down, and closed somewhere here. Then it continued up, came here, broke below it, went above it, and then came back again before pulling back to the same place. Okay, so how is this useful? Knowing the previous day's highest high and the previous day's lowest low, how is that useful? Okay, the answer is simple. Anytime the price establishes a high, that's the high of the previous day or the low of the previous day, there's extremely high chance that if the price reaches the same place today or the day after that, it's likely to either consolidate or break out and then pull back to the same place. So what that means is this: if we have like a resistance here, we have a support here, then for some reasons the price closes below that level, there's high likelihood that the price may come back to that point, consolidate around that area, and then break below it before continuing in that direction. So there are cases where the price may touch this point and then pull back immediately, and there are cases where the price may break below this point, consolidate below this level before actually continuing in that direction. So this is important because anytime you have something like this, if you have the previous day's highest high, you have the previous day's highest high, the previous day's lowest low, this automatically becomes a level of significance during the next day. So it's like it's a very easy way of identifying a possible support or a possible resistance come the previous day. Does that make sense? So this is the first thing. Identify key highs and lows of higher time frames. So some people may do 4 hours, some people may do daily, some people may do monthly, some people may do even weekly charts. But in this case here, I'm focusing strictly on the high of the previous day and the low of the previous day. So when the price breaks below that low or that high, and then I see some struggling like the one we have here, that basically means that the price will continue in that direction. So there is something else. This is normal, this is common knowledge that anybody can say this. But there is something else which is hidden behind it. While the price is consolidating, it actually normally forms some shape. So we have the low here, but if you expand this just a little bit, assuming we now push this out away because we know where the area is, if you have that, you draw a line here, and then you draw another here. So you can see entirely that there was actually a very good shape which formed from around the previous day's lowest low. So when this happens, anytime the price is around the previous day's lowest low or the previous little bit, for what I was saying, you remember we are here, I was explaining why you should look, where you should look for shapes. So anytime we have a daily low, like you saw daily low, the previous day's daily low was actually somewhere here. And then you find that the price is actually consolidating around that area. It's always your job to try and ensure that you find a shape out of what's consolidating. So you'll get most of the time that if this is not an expanding wedge formation, it may form a contracting wedge formation. So a contracting is actually something like this, where the price will be entering it and then consolidates inside these two lines before eventually breaking above or before breaking below it. So when that happens, if the price eventually breaks below, like in this case here, this candle actually broke below it. You can see there was this pullback before there was this sell. So at this time, that's always where the catch is. That's where you should start looking for a very good position. So this means that we'll sell it after this breakout, and then we have our stop loss above the shape itself, which is somewhere here. You can see what happened. The price eventually went to the lower side. So this is one main thing you have to understand. So when this happens, if the price forms a converging, an expanding wedge formation like we've seen here, then later it forms some other shape like this one here. Those are still places where we want to look for positions from. So you can see it actually signals the fact that we are somehow, we've ended the sell which we had from the start. So we had a sell here, the price has gone down, we've actually gone above this triangular formation, and now we are buyers. So if you took a sell, we took a buy, we take a buy there, and then we had a sell here. So we'll sell it around the previous day's lowest low, and then we come and buy it here. This means that somehow the daily low for today has been established. This is what this simply means. It means if you see a shape forming after the days, just before the day closes, or maybe some hours to the day close, then that would be a sign that this may likely be today's lowest low. This line here may likely be the low that we've had today. So if, for instance, if the price now moves down tomorrow, assuming the price comes down and touches this line here, we'll be looking for a similar thing. We'll be looking for like an expanding wedge formation or a contracting wedge formation, or even just a normal triangular formation. So when the price gets here and then we see some consolidation, then that is going to be the best place where we want to consider looking for a shape from. Does that make sense? So I would have loved to continue, but that's the strategy which I wanted to introduce to you today. We are going to build it from that point. I would really love to build it in our next session. We are going to build it further. We'll look at other things like real-time shapes, how you can either use it, you can use it for maybe 15 minutes, or you can use it for 1 minute, but the principle is just the same thing. An expanding wedge formation around the previous day's clear area, then you take a trade after that. So thank you very much. I will meet again next week at the same time. Thank you and see you.